Okay, let's jump right in. In any business, you spend money and you make money. Sounds pretty simple, right? Well, not so fast. How you classify every single dollar that comes in or goes out can totally change your company's financial story. Today, we're going to unpack one of the most important ideas in accounting, the difference between capital and revenue. Get this right, and you get a true picture of your business. But if you get it wrong, well, the consequences can be huge.
So, to get us started, just picture this. You run a great little coffee shop, and you've just bought a brand new top-of-the-line espresso machine. It's a big purchase. But when it comes time to do the books, what is it exactly? Is this a long-term investment that's going to make you money for years? Or is it just another cost for the month, like your beans and your milk? The answer to that simple question is really at the heart of everything we're talking about today.
All right, let's start with the money going out the door. Pretty much all business spending can be sorted into one of two buckets. And the easiest way to think about it is this. Are you spending money to build your business for the future, or are you spending it just to run the business today?
So first up in our building bucket is something called capital expenditure, or what you'll often hear called CapEx. This is the money you spend on the big stuff, the major things that are going to help your business for a long time. We're talking more than just 1 year. This is your investment money, used for buying assets that will create value way down the road.
And we're usually talking about pretty significant things here. Buying new machinery, putting up a new building, or even doing a major upgrade to an asset you already own. Heck, even the cost to get that new espresso machine installed and running, that's all CapEx because it's creating or improving an asset that's built to last. Now, on the other side of the coin, you've got revenue expenditure. This is your running money. It's all the stuff you have to pay for just to keep the lights on and the doors open, day in and day out. The key difference here is that the benefit from this spending gets used up almost right away, definitely within the same year.
This is the everyday stuff, the day-to-day grind. It's paying your rent, your employees' salaries, the power bill. These costs aren't building you a new asset for the future. They're just maintaining what you've already got, right now. They're the essential costs of just doing business.
So, here it is, the most crucial part. Capital expenditure, your building money, creates future value, and it gets recorded on your balance sheet as an asset. But revenue expenditure, your running money, is a cost for right now, and it directly reduces your profit on your profit and loss account. And trust me, that distinction changes everything.
Okay, so we've covered all the money going out. Now, let's flip the script and apply the exact same logic to the money that's coming in. Is it regular income from your sales, or is it a one-time windfall from somewhere else?
So, capital receipts are basically the inbound version of CapEx. This is money you get that doesn't come from your main business activities. You should think of these as kind of unusual, often one-off injections of cash that aren't tied to you actually selling your product or service.
So what does that actually look like? Well, if an owner decides to put more of their own cash into the business, that's a capital receipt. Same thing if you take out a big loan from a bank, or if you sell that old espresso machine you just replaced. Yeah, it's cash coming in, but it's not a sale.
And now for the one everybody loves to see. Revenue receipts. This is the good stuff. This is the money your business earns from doing exactly what it was created to do. It's the income that flows in from your core, day-to-day operations. It is, quite literally, your business's lifeblood.
Back to our coffee shop, this is every single latte you sell. It's every pastry, every bag of beans a customer buys. It's all the cash in the register and all the credit card sales at the end of the day. This is the income that shows you how well your business is actually performing.
Okay, we've got the definitions down, but why does any of this really matter? Who cares what bucket you put it in? Well, you should. Let's get to the consequences, because this has a massive, direct impact on your bottom line, your profit.
So, the single biggest, most common mistake people make is taking a huge capital purchase, like our new espresso machine, and just writing it off as a regular monthly expense. I get it. It seems simpler in the moment, but it paints a really misleading and frankly dangerous picture of your business's health.
And look, that's not just my take. It's a fundamental rule of accounting. Getting this wrong isn't some small clerical error. A wrong classification will completely distort your profit, making your business look way worse or sometimes way better than it actually is.
Let's see this in action with some simple numbers. In this version, the coffee shop brought in $100,000 in sales. Great. But they made the mistake of expensing the entire $10,000 cost of the new espresso machine this month. And look what happens. Their total expenses ballooned to $80,000, leaving a net profit of only $20,000. Ouch. It looks like they had a really rough month.
Now, let's do it the correct way. That machine is a capital asset, so instead of expensing the whole cost at once, we spread that cost over its useful life. It's a process called depreciation. So let's say that's $1,000 for this period. All of a sudden, total expenses are way lower, and the net profit is $29,000. That's a 45% jump in profit just by putting one number in the right place. This is the true financial story.
All right, you've seen the theory, you've seen the impact, now it's your turn. Let's run through a couple of quick scenarios. Time for a little pop quiz to see if you've got it. Ready?
First one, you buy a brand new, powerful computer for the office. It's an essential tool. How do you classify it? Capital or revenue?
That's right, it's capital. A computer is definitely going to last and provide value for more than just 1 year, making it a classic long-term asset. You wouldn't expense the whole thing in one go.
Okay, next up, nice and simple. The electricity bill for the month comes in and you pay it. Capital or revenue? What do you think?
That one's a slam dunk. It's revenue. You paid for the power you already used. The benefit is gone, consumed. It's a classic cost of just running the business.
All right, last one, and it's a biggie. You decide to do a major renovation of your whole office. New walls, upgraded wiring, the whole shebang. What's the call on this one?
You got it. It is absolutely capital. This isn't just a simple repair. You're fundamentally improving a major asset, the building itself. The renovation increases its value and extends its useful life, giving you benefits for years and years to come. So, to wrap all this up, I want you to think about it for a second. Think about the last big purchase you made for your work or your business. Was it a revenue expense, where the value was used up right away and it's gone forever? Or was it a capital investment, an asset that's still helping you, still benefiting you today? That one question is the key to understanding the real financial health of any business.